It has been pain for investors in US stocks, and that's helped to drag down the Canadian market. Let's get more from Scott Chronert, US equity strategist at Citi. Scott, thanks very much indeed for joining us. Of course, there's always blips in any bull market. What do you think has caused weakness this week?
Well, I think you're identifying this correctly, Andy. We're looking at a bit of a blip, or let's call it a pullback. You know, we went into the Q3 reporting period with pretty lofty expectations, whether you measure it through valuations or we look at some of the implied growth characteristics underlying these stocks. And I think very simply what's happened is that you kind of stretched the expectations so far that it's very difficult for the incremental news flow to support stock prices short term. By no means does this mean the long-term trajectory in terms of the AI playbook is over. I think it just means that from a shorter-term perspective, we're in one of these periods now where you're getting a bit room for pause on the heels of what's been really, really good performance since the April lows.
There are concerns, of course, about the incredibly ambitious forecast for revenue from AI. As you know, I was talking about this yesterday. OpenAI are talking about spending $1 trillion or so over the next decade. Has this stuff got out of hand?
Well, I think, I think when you talk about that degree of spending, it does two things. It gives you a fundamental tailwind for everything and every company that's sort of in the line of sight of that spending. But what it also does, it begs this question of when is enough too much? And do you get to a point where it's difficult to justify the incremental investments? That's a storyline that's been in the market for several months, and I think will be in the market for months to come. At this point in time, though, it does look as if the underlying demand for AI, let's call it strategies, is in excess of supply. So I think the underlying tailwind here is still in pretty good shape, but we're going to have to be navigating these nuances as they come up over time.
What themes emerge? I think you and I have touched on this before, Scott, but what themes emerged for you from the earnings season?
Well, I think, the way we've looked at it, it was a very strong reporting season here in the U.S. with earnings up, let's say, 11% or so above consensus for 8% going in. But the formula for success in this reporting period has been not just a Q3 earnings beat, but you needed also to see Q4 estimates revised higher, and you needed to see 2026 full year estimates revised higher. Essentially, what we have to keep in mind, Andy, is again, this is a market that's had a very strong run. The valuation concept comes up all the time. But what's happening is that we're premising views on these companies, not on 25 results, but on where you think 26 and beyond expectations are going. So the formula for success during the earnings season has been to feed that machine where you see ongoing upward trajectory in out-year growth expectations. That's been probably the single biggest differentiator, whether you're in the large cap part of the U.S. or down in the small mid cap as well.
I think you've talked to us about this before, reluctant bulls. The market doesn't want to be bullish, but finds itself obliged to be.
When you're a professional investor or even a retail investor, and you're looking at the action that's been in the markets, again, particularly since the April lows, it's hard not to engage and to participate. And so what we're sensing in our work is this combination from a positioning perspective. Investors are very well engaged in the market with equity allocations, high versus history. But when you look at some of these specific sentiment indicators, it's a much different picture. There's much more ongoing concern, much like we're talking about right now in terms of how to think about some of the spending trajectories. So the way we frame this is that we've got investors that are in the market. They know they've got a valuation concern, and this bubble phrase keeps coming up a lot. But the sentiment is a little bit more, let's see, middle of the road, if you will, than the positioning is. So what that means in terms of our reluctant bull concept is that incremental news, when you're pushing those expectations for the out year higher, are going to get rewarded, which is the tail of Q3 reporting season. But at the same time, any noise that comes into this perfect setup is going to trigger selling, which is what I think we're dealing with this week in particular. So the reluctant bull component has two aspects to it, a bullish and a not so bullish response. This week, we're seeing the not so bullish or bearish response.
Broadly speaking, what will 2026 look like? Is there a prospect for a decisive catch-up, for example, by the small and mid-cap stocks?
So I think there is, right? So the 2026 setup, given the valuation starting point for the U.S. markets in particular, is such that you can't really expect much in the way of a valuation improvement going into 2026. Rather, the way we think it'll play out is that it's going to be much more aligned with where earnings growth trends take us. As I mentioned, for 25 targets, we're already using 26 estimates into our assumptions. So as we go into next year, we're going to be quickly fast forwarding to, again, how persistent is this earnings growth tailwind that we're looking at? Will it persist into 27 and beyond? My point here being is that we think we're in very good shape for an earnings acceleration more broadly next year. But interestingly, we think that there's a catch-up growth opportunity, whether it's in U.S. small mid-cap. You can probably also say the same thing about outside of the U.S. or some of the international markets. So this broadening construct we think is going to be ongoing as we go into 2026. So we want to be engaged in this AI playbook. We think it has legs to go, but we think there's a good argument for new money going into other areas that haven't participated over the past couple of years to the same degree. U.S. small mid-cap would be one of those.
Scott, thank you very much indeed. I really appreciate it, and have a great weekend.
Thanks, Andy. Take care.
Scott Chronert, U.S. equity strategist at Citi.